There is a number. It will be published Tuesday morning at 9 o'clock Eastern Time, quietly, without ceremony, by the CME Group, the institution that operates COMEX, the commodity exchange in New York. No press conference, no announcement, just a vault count posted to a spreadsheet that most Americans will never open, most financial commentators will never mention, and most investors holding silver in one form or another will never even know exists. And yet that number, the registered silver inventory figure, may well be among the most consequential single data points published this week in any market, in any asset class, anywhere in the world. That is not hyperbole, it is arithmetic. And arithmetic, unlike opinion, does not care about your feelings. Let us begin with what we actually know, because in an era saturated with speculation, knowing the difference between a fact and a forecast is itself a form of intellectual self-defense. Silver is trading this Tuesday at approximately $79.56 per troy ounce, down from its all-time nominal high of $121.67, which was set on January 29th of this year, but still nearly 30% above where it sat just 6 weeks ago in mid-March. That recovery has occurred against a backdrop of genuine geopolitical stress, a Strait of Hormuz crisis that briefly paralyzed energy markets, and a Federal Reserve holding its benchmark rate at 3.50 to 3.75%, while inflation refuses to cooperate. These are not abstract macroeconomic conditions. They are the precise conditions under which silver has historically been reconsidered by investors who previously thought it was a relic, a curiosity, a metal that belonged more to a jeweler's case than a serious financial discussion. COMEX registered silver inventory currently stands at approximately 76.88 million ounces, set against 575.5 million ounces of outstanding open interest. The result is a coverage ratio of 13.4%, meaning that for every 7 paper ounces of silver being traded on the exchange, there exists just one real, physical, deliverable ounce in a registered vault. A leverage ratio of 7.5 to 1 sounds alarming, stated baldly, but context matters. COMEX normally operates with leverage in the 5 to 8 to 1 range. The system, in other words, was designed with this disparity in mind. It functions not because every claim can be satisfied simultaneously, but because the historical assumption is that the overwhelming majority of contract holders, somewhere between 97 and 99%, will roll their positions forward or settle in cash. They will never ask for the metal itself. The entire architecture of paper commodity trading rests upon that single behavioral assumption. It rests upon the quiet, unexamined confidence that nobody, or almost nobody, will ever actually knock on the vault door and say, "Give me my silver." In January 2026, the delivery rate spiked toward 5 to 10% of contracts. In a single week, 33.45 million ounces were withdrawn from registered inventory, representing 26% of the deliverable pool in 7 days. That is not a statistical anomaly, that is a behavioral shift. And behavioral shifts in financial markets, once they begin, tend not to politely announce their intentions before accelerating. The May 2026 first notice day is 8 business days away with 47,034 contracts, representing 235.2 million ounces, still open. Physical pressure is high. Tuesday's vault count is the first official measurement of where that pressure has brought us. It is not a prediction, it is a reckoning. The broader context includes a continuing deficit in global silver supply, with the World Silver Survey 2026 projecting a 6th consecutive annual deficit of 46.3 million ounces for this year alone. This persistent shortfall has led to a drawdown of over 760 million ounces from above-ground stocks since 2021. 6 consecutive years of consuming more silver than the world produces. The supply conversation is not, in other words, a new conversation. It is an old conversation that has been postponed, deferred, rolled forward, much like the futures contracts themselves, until the moment when deferral is no longer structurally possible. Whether Tuesday is that moment, or whether the moment arrives in a subsequent delivery cycle, is the question that every serious observer of this market is preparing to answer. If you have been watching the silver market for any meaningful period of time, and you have not subscribed to this channel yet, I want to ask you directly, why not? Because what we do here is not prediction, it is preparation. We read the data before the market moves, so that when the moment arrives, you are a calm and informed participant rather than a reactive and frightened one. Hit subscribe, turn on the notification bell. This story is far from over, and Tuesday morning is not the end of it. It is the chapter that tells us how close we are to the one that changes everything. There is a concept in classical economics called arbitrage the simultaneous purchase and sale of the same asset in different markets to profit from a price difference. It is, in theory, a self-correcting mechanism. When a price gap opens between two markets, arbitrageurs exploit it, and in doing so, close it. The gap, in other words, is not supposed to persist. And yet, right now, there is a silver price gap between New York and Shanghai so wide, so persistent, and so structurally significant that it is functioning less like a temporary inefficiency and more like a one-way pump draining physical metal from Western vaults into Eastern markets with no apparent end in sight. The Shanghai silver benchmark morning fix on April 20th was priced at the equivalent of approximately $90.89 per troy ounce, a 14% premium above COMEX spot price. 14%. On a commodity trading at roughly $80, that is a spread of more than $11 per ounce. For a trader with access to both markets, the arithmetic is elementary. Purchase silver in New York at the lower COMEX price, ship it to Shanghai, deliver it at the higher Shanghai price, and pocket the difference. Every single day that this premium persists, physical silver flows west to east. Every single ounce that completes that journey is an ounce subtracted from the registered inventory that backs the paper silver market in New York. Tuesday's vault count is, among other things, a measurement of how much of that subtraction has occurred. Superimpose upon this the Indian demand dimension, which receives far less analytical attention than it deserves. India is not a marginal participant in the global silver market. It is one of its largest and most consistent consumers, drawing upon silver for industrial manufacturing, for jewelry, for silverware, and for a centuries-old cultural tradition of treating precious metals as a reliable store of value when paper currency cannot be trusted. When Indian demand surges, and recent data indicates it has been elevated, it does not arrive gently. It arrives as a tidal force, competing simultaneously with Chinese industrial consumption, with Western investment demand, and with a registered inventory arithmetic at COMEX for the same finite pool of above-ground silver. The structural supply deficit in silver stands at 118 million ounces, with industrial demand representing 59% of total usage. This is not a speculative market driven by sentiment alone. It is an industrial commodity with a physical supply problem that has been building for the better part of a decade. Now let us be intellectually honest about the macro environment, because the COMEX vault count does not exist in a vacuum, and any analysis that treats it as if it does is an analysis that will mislead you. The Federal Reserve is holding rates at 3.50 to 3.75% in an environment where March CPI came in at 3.3% and fourth quarter GDP was revised down to positive 0.5%. That is the definition of stagflation: high inflation coexisting with negligible growth. And it is precisely the monetary environment in which precious metals have historically served their most urgent function as a store of value. Silver has outperformed gold over the past year with a roughly 150% gain versus gold's approximately 56%. Silver's industrial demand in solar, electric vehicles, and AI infrastructure provides a growth component that gold lacks, while COMEX physical tightness supports the supply squeeze thesis. Silver, at $79.60 on April 17th, is approximately 34.6% below the $121.67 all-time high of January 29th. The correction is real, and short-term volatility will continue. What is not corrected is the underlying structure. The COMEX coverage ratio did not improve through the correction. The eligible pool did not refill. The paper leverage ratio did not compress. These are not price signals. They are physical infrastructure signals, and they move more slowly and more consequentially than spot price. This distinction matters enormously. Price is what you see on a screen. Structure is what determines where price must eventually go. When price and structure diverge, they do not diverge forever. One of them is wrong. Given that price is determined by the daily trading of paper contracts and structure is determined by the physical reality of metal in vaults, a thoughtful observer might consider which of the two is more likely to be accurately reflecting reality. Silver's current nominal all-time high is $121.67, set on January 29, 2026. The 1980 record of $49.45 would adjust to $194.42 per troy ounce in today's inflation-adjusted terms. Bank of America's forecast for silver in a scenario of historical gold-to-silver ratio compression ranges between $135 and $309 per ounce. These are institutional numbers from institutional analysts, not the projections of fringe commentators. They reflect a growing recognition in the most conservative quarters of professional finance that the paper-silver market's relationship to physical reality has become increasingly difficult to defend. What you watch for on Tuesday morning is specific. The registered silver number, not eligible, registered, is your signal. Registered silver has declined 2.3% over the past 30 days, with 1.8 million ounces withdrawn. The paper leverage is elevated at 7.5 times, significantly more paper claims than deliverable metal. If Tuesday's count accelerates that trend rather than reversing it, the market will be forced to confront arithmetic it has been postponing. If the number stabilizes, the pressure migrates to the next delivery cycle. Either way, the structural story does not change. Either way, Tuesday tells you something important about how close to the edge we are. In the winter of 1980, two Texas oil brothers named Nelson Bunker Hunt and William Herbert Hunt discovered, at considerable personal financial cost, that attempting to corner a commodity market is an endeavor the exchanges will not tolerate indefinitely. When their accumulated silver position had driven prices from roughly $6 per ounce in 1979 to nearly $50 in January of 1980, COMEX responded by implementing what it called Silver Rule 7, a set of restrictions on leveraged silver purchases so severe that the buying pressure collapsed overnight. Silver fell from $50 to $11 in a matter of months. The Hunt brothers' losses were measured in billions. Their lesson, intended for the ages, was that the rules can be changed when the rules become inconvenient for the institutions writing them. What makes the current situation structurally different from 1980 is not the direction of the price pressure. It is the source. The Hunt brothers were accumulating paper claims on silver for speculative purposes, driving a price disconnected from physical supply fundamentals. What is happening now is, in meaningful respects, the opposite dynamic. In early 2026, the simultaneous demand for physical delivery by multiple actors appears to have strained the assumption that most holders would remain content with paper settlement. In just 7 days in January, 33.45 million ounces of silver were physically withdrawn for delivery, representing roughly 26% of COMEX's registered inventory in a single week. This was not a speculative attack. This was demand for the metal itself. And that distinction matters enormously because the exchange's traditional response, changing the rules to discourage buying, does not address a situation where the buyers are not speculating on price. They are simply asking for what the contract says they are owed. Each 1% increase in the delivery rate on the May contract above historical norms would require an additional 5 to 6 million ounces of registered metal. At current registered levels of 76.88 million ounces, a repeat of January's intensity, even at half the magnitude, would draw down approximately 21% of registered inventory in a week. The May 2026 delivery cycle is approaching first notice day in 8 business days. Tuesday's vault count is not an abstract academic exercise. It is the last significant inventory measurement before that clock expires and the delivery mechanics begin in earnest. The traders and institutions holding those 47,034 open contracts representing 235.2 million ounces of silver will begin making their decisions, roll, close, or stand for delivery, in the days immediately following this count. What the number shows them will influence those decisions in ways that no amount of paper market activity can override. There are 3 realistic scenarios, and intellectual integrity demands that all 3 be stated plainly. In the first, Tuesday's registered number comes in dramatically below where the trajectory suggested, confirming an accelerating drain, and the market reprices silver sharply higher as short sellers begin covering and physical buyers accelerate their positioning. In the second, the count confirms the trend without shocking the market. Silver moves modestly higher, and the pressure migrates into the May delivery cycle, where it builds further. In the third, a temporary washout before the count flushes weak-handed holders at a lower price before the data confirms the supply picture and the metal recovers. The COMEX physical data tilts the probability toward the upside resolution. A 13.4% coverage ratio and a 12 to 13% Shanghai premium are not typical of a market about to break lower. What is not in doubt is the durability of the underlying structural argument. The World Silver Survey 2026 confirmed a projected 6th consecutive annual deficit of 46.3 million ounces for 2026, with approximately 762 million ounces drawn from above-ground stocks since 2021. 6 consecutive years of deficit. 6 consecutive years during which the world consumed more silver than it produced, drawing down the finite above-ground inventory that backstops every futures contract, every ETF share, every paper promise of metal that will someday be delivered. Tuesday does not resolve that structural reality. It measures it. It tells us, with precision, how much further the inventory has traveled down a road with only one terminus. Before Tuesday morning's 9 a.m. report drops, know your position and know your thesis. Bookmark the CME Group's daily metals report. Watch specifically the registered figure. Watch silver's spot price reaction in the first 30 to 60 minutes after publication. Watch whether silver begins to outperform gold. If the gold to silver ratio falls after the count, it signals that silver-specific supply dynamics are driving the move rather than general precious metal sentiment. These 3 data points together tell you everything the number is saying, and they tell you whether Tuesday is the catalyst or merely the precursor to one. Now, before you close this video, I want to know something from you, and I want you to tell me in the comments right now. Not tomorrow, not after the vault count, right now before the number drops. Are you holding physical silver, paper silver through ETFs or mining stocks, or both? Type it out. Physical, paper, or both. Because the answer you give tonight before Tuesday's data is the answer that reveals whether you are positioned from conviction or from momentum. I read every comment on this channel. I respond to as many as I can, and there is no more honest signal of where this community stands than the answer you give before the market tells us who was right. Drop it in the comments now. Because Tuesday is already here. 9 o'clock comes whether you are ready or not, and I will see you on the other side of the number. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.